By the way, folks that are coming in, if you happen to be social and you're in a place where there are other people, let them know this webinar is taking place, please. I want to get this as full as possible. I promise you're going to enjoy the conversation. I am a big fan of both Eric, Greg. I'm also a fan of Melody's, and I think you're going to enjoy this conversation about the George Costanza trade, which, by the way, I got an email from somebody saying, I don't know how much of your audience is going to get that reference, but it's a good reference. I was a big fan of Seinfeld back in the day. So with that said, appreciate everybody that's coming in here. My name is Michael Guyed. This webinar is sponsored by OptionsANIMAL. I'm going to be in the background as Melanie hosts this great conversation around options trading. If for those that are here for the CE credits, just wait to the end of the presentation. I will email you afterwards, get your information, and I'll submit it to the CFP board. And with all that said, Melanie, take it away.
Thank you, Michael. Well, I'm really excited about today's session because I'm joined by Greg Jensen from OptionsANIMAL and Eric Hale from Trader Oasis. And every time these two are here, we get a mix of discipline, structure, and real-world trading logic that cuts through the noise. Greg's the founder of OptionsANIMAL, a published author, former hedge fund manager, and RIA node for precise trade adjustments. And Eric's the founder of Trader Oasis, a four-time forecasting award winner recognized by the Chicago Fed and an active real-time educator. Today, we're getting into a concept that Eric has spent years refining, the George Costanza trade. It's a trading approach built around doing the opposite of what you think, or in this case, of what most traders instinctively want to do. It's great to have both of you here.
Thanks, Melanie. This trade's a lot of fun. Just a little bit of background. So OptionsANIMAL teaches people how to trade. I started as a student myself. So it's close to 25 years ago. I attended a webinar and said, hey, this looks like something for me. I was a engineer putting money in my 401k. I'd gone out and bought options here and there and made some money, lost some money. And I knew there was something there, and options were gaining traction. And certainly every year you see the volume of option trading going up and up. So after I took the curriculum, I don't know, Greg saw something in me he liked, and he asked me to come teach. And so it's been almost 22 years now that I've been trading with OptionsANIMAL. And the approach at OptionsANIMAL is a very disciplined, rigorous process that's pretty straightforward, easy to follow. It's a 6-step process. And one of the most important parts of that is our exit plan. And if there's one thing I could tell any of the traders that are here today that you could do to improve your trading, and that is to set a goal. And think about anything in life. If you don't have a goal of what you want to get to, how do you know when you get there? So in trading, you should have a goal. And you should also have some sort of a mitigation strategy, what we call as a secondary exit. And that is, what do you do when what you hope happens doesn't happen? And so this is the 4th step of our 6-step process, is to define your exit. So primary exit is what I want to have happen. Secondary exit is what do I do if the opposite doesn't happen, or if I don't get what I expect as my primary exit. Greg, do you have anything to add on that? I'm going to talk a lot here because you know how I am about the Costanza. Do you have anything to jump in and say at this point?
Well, yeah, I'll just say that I hired you for your humor and your good looks.
Thank you very much. Thank you.
No, I am going to actually let you take the bulk of this, because this is a trade that you took a known trade, and it's not like you created the bear call spread. I mean, that's really what we're going to talk about today. But the approach that you use with it, and really as you were talking about your secondary exit plan, is what do I do if I'm wrong, is what is unique. And it's a very intuitive way to trade the market and not feel like I got to nail it perfectly or I'm not going to make money. I mean, that's the hard part about trading. And NVIDIA is the story of that. If you look at this year, NVIDIA, if you were a buy and hold investor, has been a fantastic year, right? Yeah, except for you've had to deal with enormous drawdown, then enormous rallies, and volatility all along the way. And if you follow typical trading rules, it's destroyed you this year. Whereas, the approach that you have and that we teach at OptionsANIMAL is know your equities, know your secondary exit points. And if you know that and can take emotion out of the game, it changes the way you view the market. And so for me, I love this approach. I love this way of trading. So yeah, I'm going to let you take the floor and run with this, because this is a trade that you've perfected over the years.
To make sure we're going to start at the beginning, I want you to start with, what is the George Costanza trade? Michael had mentioned that people might not even know who George Costanza is from Seinfeld, but what is it and what pushed you to build a strategy around it?
I'm hoping that everybody out there has heard of the TV show Seinfeld, and you know the character George. And if you've ever watched an episode, you know this guy's kind of a little bit of a bumbling idiot, if you will. And it's comical because he always makes mistakes. And I think it was season 5. There's an episode called The Opposite, which is definitely one of my favorite episodes, where Jerry tells George that every instinct in your life has been wrong. And by that logic, you should do the opposite of whatever you think. And, of course, he normally orders, he normally orders tuna on toast, but then he changes his mind. He gets chicken salad on rye, and he orders a cup of soup or something. And there's a woman at the bar who turns and looks at him and makes eye contact with him. So Jerry tells him, you should do the opposite, because normally he would just ignore it. So he goes up and explains that, hey, I live with my parents and I'm unemployed, and ends up hitting it off with the women. And so the whole opposite episode is about George doing the opposite of everything that's his instinct, and then actually having it work out for him. So where I got this notion is, I'm a pretty optimistic person. I think a lot of people are too, and most people want to trade bullishly, and certainly trading bullishly over the past 20 years has been a good trend, right? We've been largely in bull markets since then. We've had a few pullbacks, and I think most traders tend to enter trades looking for a bullish equity. And there are a number of different option strategies that you could use. You could buy long calls. If you buy long calls, you need more than just a bullish move. You need a very bullish move. There's a premium that has to be overcome. And if you only get a small bullish move, a long call is going to lose money. You can flip this sort of strategy on its head by also selling options. If you sell a put, so a strategy that a lot of people use, cash secured puts, naked puts, maybe even bull puts. People sell puts because you're agreeing to buy the stock if it goes down, and you're receiving a credit. So in that situation, you're getting a small return in exchange for actually a significant risk. That trade does have a lot of risk in it, but it's also a high probability trade. And that takes me to one of the concepts that we teach in OptionsANIMal is what we call the purple nacho. So long story how I got the name, but the concept is that if you think of options falling into a 3-sided graph, now most graphs have an X and a Y. Imagine a triangle, something that's shaped like a triangle. And on one axis, you have your maximum profit. So low profit, high profit, everybody, well, I want high profit. Okay, well, on one other axis, you've got high risk and low risk. And on the third axis, you have high probability and low probability. And the way this works is if you adjust any one of those characteristics, you affect the other. The concept came to me as an engineer when a mentor explained to me that you could do a project, and you people, maybe some people in IT have heard this before. You can do something fast, you can do it good, or you can do it cheap. You can pick 2. So you can't get all 3. You can only get 2. The purple nacho in options means you can either have low risk, high reward, or low probability, high probability. You can probably get 2, but you can't get all 3. And with a short put, what you get is a trade that's very high probability. It's probably going to work for you, but the profit is relatively small and the risk is relatively large. So those risks don't usually happen most of the time. So those are high probability trades. And when you think about that sort of trade from a secondary exit standpoint, and I mentioned what the secondary exit of a short put is already, and that would be to take ownership of shares. And my guess, is that there are many people listening to me right now who have done exactly that strategy, where you sell a put, collect a premium, reasonable premium, high probability you're going to make money on that trade. And if it goes down, you end up taking ownership of the shares. That's the assignment process of the short put. Now, some people may or may not like that strategy. I prefer not to do that strategy. I prefer to do a bull put. So this is a put credit spread where I sell a put and buy a put. And that strategy is also a bullish strategy. Now, it tends to make slightly less money and has slightly lower profit. But if remember that nacho, the triangle I said, if something got better or worse, if something got better, something else got worse. And conversely, if something got worse, something else got better. And in that situation, if you have a bull put, what you get is significantly lower risk. You have a long put that limits your risk. So you, in exchange for smaller profit and it's still a high probability trade, but not as high probability as a naked put, you get lower risk. And if the stock goes down and you take ownership, you've got a long put that offers you protection. And this is a very favorite strategy for spread traders. A very common strategy for bullish traders is to do the bull put spread, a short put that's out of the money and a long put further out of the money. And if the short put gets assigned, you've got a long put to limit your risk, and you take ownership of shares. And so that's a very common bullish strategy. And I'm going to tell you that I used that strategy probably for the better part of 15 years. Whenever I was bullish, I would do a bull put, because anybody listening to me, and there's people right now that are, yep, I know all of this. Let me ask you, how do you feel when that short put goes in the money? You're going to end up taking ownership of the shares. How do you feel about it?
You feel like you just got kicked in the gut.
Okay, yes.
Right?
But how do you feel about taking ownership of shares when you sell a put here and the stock's up here?
Yeah, you're nervous, right?
Well, to be honest with you, I'm like, oh, the stock's trading at, let's take Robinhood trading at 117 right now. If I sell a put at 115, okay, I'm going to buy the stock at 115. But if Robinhood drops down to 112, so if the stock's trading at 117 and you say, oh, I'm going to sell a put at 115, which means I'm going to, buy it and my cost basis will be like 112. Oh, okay, I'm happy with that. But if the stock is down below 112, you're not happy about it. So when you sell a put, you feel good. Do you feel this way, Greg? When you do a put?
Oh, yeah, no, you have this fear, this nagging. It's like, okay, I'm buying a stock right now that felt good at the time because I did the math and I did my homework. So I'm like, okay, fundamentally, I'm okay with owning it there. But you're buying a stock while it's dropping, which is a little nerve-wracking.
Right. Yes. But for me, this 15 years of selling puts, is that, and I hear this from a lot of people and other people who teach that strategy. Well, you're going to buy it at a lower price anyways. But what happens when a stock starts trending bearishly is often it continues to trend bearishly. And if you were doing a naked put or a cash secured put, or I think the wheel strategy is a euphemism that people use to feel better about themselves, is that they actually had a strategy. You're buying the stock and the stock is dropping. You've got to mitigate that risk by maybe either selling calls, turning the trade into a collar trade or a covered call, maybe even buying or rolling the puts. And the bottom line is, when you follow that secondary exit, you do not feel as good as when you put the trade on, because you start second guessing yourself. I'm looking at a chart of Robinhood right now, and just a few days ago, just a week or so ago, we were like 148, 149, and now the trade's down at 117. And so it's difficult. Where's the bottom going to be in here? What's it worth? And you're owning the stock and the stock is dropping. So what I did was embrace the George Costanza approach. And that is, when I am bullish, I place a bearish trade. And there's two main reasons for that. And the second reason is the adjustments are awesome. And I'll talk more about that. But the first reason is that I am terrible at stock picking. And the truth is, you suck too. Everybody listening to me, if you kept track of your bets, and you don't, but if you did, if you kept track, you probably couldn't beat the flip of a coin. There's a website that I like to cite. It's cxoadvisory.com. So that's Charlie X-ray Oscar CXO Advisory. If you go look on their guru grades, on the right-hand side, there's a study that they did. And they looked at the experts in the field, the people that you see on CNBC every day, hedge fund managers, people that are very well known, whose job it is to prognosticate the future. And would you be surprised to learn that 67% of the people on the list, now keep in mind, these are people whose job it is to forecast. 67% of the people are wrong most of the time. They cannot beat the flip of a coin. 67% of the people on this list. And they are, of course, Jim Cramer was like, yeah, Cramer's on the list. Now, the world-class performance, the best of the best are right 60% of the time. If you can be right on stock direction. So this is a good calibration for all of you to think about. And we have all sorts of heuristics and biases and how we act. We tend to be risk avoiding, and we cut our profits too soon. Maybe we let our losses run too long. We have all kinds of behavior that we do that does not help us out. And we tend to be bullish sometimes at the worst time. Now there's, some good data that says when stocks are near all-time highs, I was talking with Greg about this recently. If you go back to 1970, when a stock hits an all-time high, 96% of the time it'll hit another all-time high within a year. So stocks tend to go bullishly. So being an all-time high, but when you look at a stock that's in a very bullish trend, we tend to, as humans, expect the same trend to continue. And that's just not how stocks move. They don't usually go straight up. They kind of zigzag and they go up and down. So why do I place a bearish trade? So the first reason is because I suck. And when I'm bullish, I'm probably wrong. But the second reason, as I mentioned, is the adjustments. So the spread that I'm talking about doing, the Costanza trade, as Greg had alluded to earlier, is a bear call spread. So you sell a call out of the money and you buy a call a little higher. Now, we've talked about two very popular credit spreads, and anybody has a little bit of experience or maybe a lot of experience trading options, you know that we're talking about an iron condor. Those two trades are an iron condor. That is not the strategy, although that's a very interesting approach, is to do an iron condor here. An iron condor involves selling a put and buying a put further out of the money, selling a call and buying a call further out of the money. And you've got something, and we just wrote about that in our Substack, by the way, talking about doing trades like that over earnings. So if you haven't already, checked out OptionsANIMAL's Substack. Just go to Substack, search for OptionsANIMAL, and start following us there. You'll get some good content that we're pumping out. But an iron condor is two credit spreads. So I'm not talking about doing those. I prefer to do the out of the money bear call spread. So the out of the money bear call spread, you sell a call and you buy a call. This is a high probability trade. So you probably are looking at something around 60, 70% chance of this trade working. Now, the risk is bigger than the reward. So you need to do some math here when you're putting these things together. Just as an example, I was playing with one right now with Robinhood, selling a 120, buying a 130 would bring in $350, and the max risk on that is $650. one contract. And the probability right now is about a 61% chance of that thing breaking even. So the break even on that trade would be 123.50. The stock is currently trading at 118-ish. So the stock needs to go up about $5 before you get to the break even. So that you got a pretty good chance of this trade working for you. The adjustment, though, is to remember that you came about this trade because you're actually bullish, but you know you're terrible, so you placed a bearish trade. So the stock, most of the time, is not going to go up. At least, probably more than 50% of the time, the opposite thing happens. So the stock goes down, you keep that 350 as your credit that you receive when you sold the trade, and maybe the trade expires worthless or you close it early to capture most of the profits. Now, the adjustment on this is to buy the stock if the trade goes higher. And if you will, envision with me what that trade is now. So you had a short call that's out of the money and a long call further out of the money. If you have a short call and you add stock to it, what trade do you have? You have a covered call. Very good trade, very common trade. People buy stock, sell a call. You're agreeing to sell your stock at a higher price. So this is a little bit different. You're not buying the stock and selling the call. You already have the short call in place. So it's very important that you know where to buy the stock. And the answer would be buy the stock ideally at the short call strike. So in this case, 120. So the stock goes to 120. You buy the stock. Now, if you do that, you are now in a high probability trade. You started in a high probability trade and it started to get challenged. And if you buy the stock at 120, because you already received a credit on this spread, a $350 credit, when you buy the stock at 120, your break even now is 116.50. Remember, the stock went up to 120. So the stock can turn around and go down and you can still make money. So you're in a high probability. And this notion of thinking here, sometimes called Bayesian adjusting. I don't want to nerd out on you too much, but Bayes was a mathematician and understood probabilities. And this is recognizing that if you stay in a high probability trade and then the low probability things happens, you've got an opportunity to put the trade back into a high probability trade. So this business model is how casinos and insurance companies make money. So we're sticking with the probabilities, but back to what the trade is when you adjust it. So you buy the stock at 120. You have a call at 120. If the stock stays between 120 and 130, the worst case profit is still $350. So it's the same profit if you end up selling your stock. But you also have a long call. So before you had this bearish trade, you had a short call and a long call. Now you add stock to it. The trade now is a covered call with an extra long call, which means it has unlimited upside. And I've had some people who are some of our students tell me these have turned out to be the most profitable trades they've ever placed. Because if the stock continues to rocket higher, that long call has no limit to how much money you can make on the upside. So it really comes down to a decision on what do you do with that long call. And chances are, if the long call has some value in it, you can close that long call for a profit. So if the stock moves up to 120, you close the long call, and whatever you bring in, now you're going to have an even higher profit if you do end up selling your stock, and a lower break even, and thus a higher probability. Now, the challenge with this trade is if you can't catch it at the short call strike, you have to go up to, say, 120 on the break even on this example here. 123.50 for me is the trigger where I say, this is where I'm going to buy the stock. Absolutely. Now, sometimes stock goes up and maybe it's going to pull back a little bit. So let it go a little past 120. 120 is ideally where I want to buy it, because I don't want to have the stock go up and then have it go back down. And we'll talk about that in a second here. But at that, knowing where your break even is where you would close this trade, or not close the trade, buy the stock. And at that point, we think about what's happening. The stock is going up, so the short call is getting more expensive, and that's a negative thing for you, right? You sold this call, you want the call to get cheaper, whether time works away at it or the stock price goes down or volatility goes down. All of those things can make that call go down in price. But the stock has gone up, it's been bullish, and this short call now has become more expensive than you sold it for. The long call is getting expensive too. So this is where, if you take a look, and it depends on the timing on this. When does it happen? If it happens right away, sometimes it's a little bit better. But at that point, you're looking at adjusting the long call by closing that and putting yourself into a covered call. And it depends on how much that call is gained. The long call is gained, but you could be in a trade where you're making the same or more money at that point. Sort of the worst thing that can happen is literally the worst thing that can happen in this trade is the stock to rocket very, very high, for the stock to go soaring past the 130 long call. Now, here's the thing that you have to, and I mentioned you need to do the math. Here's the thing that you need to understand, and a really fundamental thing for the way that we trade options is to treat it like a business and to be serious about it. And there's a lot of people that are out there that trade options because it's fun and they gamble. And Greg and I may be known to be found at a crap stable if we're in Vegas. So we do gamble every now and then, but we take our trading very seriously. And I implore you to do the same with your money. And if you hired a money manager, a wealth manager to manage your money, you would ask them some very specific questions, like what strategies are you going to deploy? What are you going to do if you're wrong? And you should have answers to all those. What sort of returns am I going to get? So in this trade that I'm looking at right now, let me do some quick math. I wasn't planning on doing this, but let's just to get the annualized return on risk. So one of the math calculations you need to do is look at how much capital you're putting into this trade. How much money am I investing? And how much money could I potentially make? And am I getting a return on the capital that I'm using in this trade? Now, we're not putting capital in the trade yet, but I mentioned you'd have to buy the stock. So you have to have the capital available. You have to have whatever we said, 120, so it'll be $12,000 or maybe $12,340 or whatever the number is, or maybe even more than that, depending on where the stock goes. But the first thing that I want you to do is to do a calculation, an annualized return on risk. And so we determine the return on risk of the trade. And in this case, it's 350. And my max risk is 650, but the capital that I'm going to use is 120. So this trade yields a return on risk of 54%. This is 350 over the 650 risk. That is 54% return on risk. And I make that in this trade this example that I'm using, I picked December 19th, so right before Christmas, a trade that would last 31 days. Now, it's important for you to also do annualized return on risk. This is important for you for portfolio management and position sizing. You're setting aside $12,000 and ostensibly you're not using that for anything else. It's cash. Now, this is a way that you can be more efficient on your portfolio is maybe it's tied up in another trade. Maybe it's in treasuries, or maybe you have it in box, BOXX, which is a really nice ETF. If you haven't taken a look at that, go look at a chart of BOXX. It's a great place to store your cash. You have to do the math on that capital that you're setting aside to follow your secondary exit. So if I'm making 350 while setting aside 120, I'm making $350 by setting aside $12,000. Is that a good return on risk? That is a 2.9% return on risk in 31 days. That is a 34% annualized return on risk. Is that good? It is phenomenal. In fact, if most money managers, most people have said, hey, somebody's going to consistently make me 10% with well-defined risk and high probability, that's pretty good. I'll take that. 20% that's phenomenal. 34% return, annualized risk. And this is realistic because it's the sort of returns that you could make consistently throughout the year. I share a portfolio at Trader Oasis, and I'm not a registered investment advisor. I'm not a money manager. I manage my own money, but I do share my portfolio with traders. My portfolio consistently over the past 3 years has yielded a 20, and this is as of this morning, 27% annualized return on risk per year. And the truth is, a return on capital, not return on risk, because the return on risk is much, much higher because I don't take as much risk. It's not all in it's not all in stock. My risk is much, much lower, well-defined. And that's how I'm able to get those returns so high, is that it's not just stock, that I'm using a combination of stocks and options to mitigate my risk. So it is completely realistic for you to consistently make over 20% annualized return on risk and or return on capital on your portfolio. And I've consistently done it for over 3 years. And I have students and clients who are doing far better than me. I'm well above the goals that I need to get to in order to retire. So I'm not saying this at all to come across as braggadocious. I don't want to come across that way. But I think it's important for people who talk to you about return on risk that they also have skin in the game, right? That I'm doing the same thing that you're doing, and credibility to show that they have, real results with real money. If somebody's pitching a product to you or some investment strategy, a very good question is to say, what do you do in your account? And I do exactly what I'm talking about right now. This is the most profitable trade. So this was a little bit of a segue or a tangent here about the importance of doing the math. And so I would implore you to look at the money that you're bringing in and think about your secondary exit capital. Think about your risk, think about your secondary exit capital, and look at the return and the annualized return. And by the way, the math on that is you take whatever the return on risk is, you multiply it times 365 days in a year, divide by the duration. So whatever your return on risk is, times 365 divided by the duration. That gives you an annualized return on risk. And it helps us keep things into perspective. Am I being efficient with my capital? Am I bringing in enough money? So those are the sort of returns you can get on this trade. The other thing that you need to do is to calculate your cost basis. When you are doing this trade, you're bringing in credits, you're adding debits, you're rolling things, credits or debits, keeping track of the cost basis so you know how much capital you have put into the trade and you understand your risk. And if you don't know what your cost base is, like those of you that are doing covered calls and you continually roll the calls, my bet is if you go back and do the math, you might find that you're not actually making money. Except for making money for your broker because you're yielding a bunch of transactions. But if you go take a look at the credits and the debits that you've received for rolling calls, you're probably lowering your annualized return on risk. And it might be better for you to just let that short call get assigned and sell your stock. Now, there are tax consequences to think about here that are important as well. But one of the biggest mistakes that I see with people doing covered calls is not letting the short call get assigned. That is where the maximum profit is. And I think I mentioned this the last time we were on. There's a Barron's article that was all about the covered call, learn about the covered call. And the author said, the risk of a covered call is the stock goes high and you sell your stock. And I had to do a double take. I'm like, wait a minute, what do you mean the risk? That's the maximum profit. That is not a risk. That's where you make the most money. And I had to read it again. And I actually wrote a letter to the author at Barron's and said, and this is their, I'm not going to say his name, but this is their options expert at Barron's. And I sent him an email and said, hey, your article on the covered call says the risk is if the stock goes higher and you sell your call. That's not risk. That's the maximum profit. It's the opposite of risk. The risk is if the stock goes down. Anyway, so there's a lot of confusion about covered calls, and Greg will talk a little bit here at the end about covered calls and stuff like that, and collar trades and other strategies. But doing your cost basis and understanding how much money you have in the trade. So the next thing that you should do on this trade is to do the math on what's the worst thing that can happen in this trade. So we're talking about this trade we're looking at right now. Okay, Robinhood's going higher. So that's 119. It was 118 when I started talking. Robinhood's moving up. The worst, if I buy the stock at 120, which is what I want to do, I'll be in a high probability trade. The stock can actually drop back down. I look at the long call and decide, do I want to keep the long call? If it's trending very bullishly, I keep it. If it's more stagnant, I close it. Chances are I'm going to be in a trade where I'll make more money, even if I get a sign, sell my stock, than I was before. Now, if the stock goes a little bit higher to that break-even point, so 123.50 in this case was the example. If I buy the stock there, I almost always have to sell the call, but I'm still probably going to be in a trade that's going to make a decent profit. What happens if the stock goes higher? What happens if the stock goes to 120 or 130 or 140? What's the worst thing that happens? That's the worst thing that happens. The stock is explosively bullish. So I wouldn't place this strategy if and I wouldn't do this under NVIDIA today. So NVIDIA is going to make a massive move today. It's pricing in a 7.3% move up or down. So that's just rough. Lick your thumb and hold it up. So when I know that's going to happen, I wouldn't use this strategy. It's not a strategy. And I want to do this on equities that I fundamentally believe I want to buy it at that strike, that short call strike. I think the stock is underpriced, and there are equities that are values out there right now that fall into this category. But the last math that I want you to do is to calculate what is your cost basis if you buy the stock when it's above 130. And it's a very easy, you need to convince yourself, you need to do the math on this. But the worst case is your cost basis, wherever you buy the stock's above 130. Remember, that's where the long call is. Anywhere above that price where you buy the stock, the worst case is that your cost basis is wherever you buy the stock plus the risk of the original trade. And the risk of the original trade was $6.50. So let's say the stock goes to 130 and I buy the stock. The worst case is my cost basis will be 136.50. Now, actually, if that happened today, I can tell you my cost basis would be 132.22. If I bought the stock at 130 and unwind the bear call, my cost basis is only $2.22 higher. Now, how hard is it for me to sell a call that's at least $2.22? And at the money call right now, if the stock went to 130, I can sell a call 1 month out for about $9. So even if the stock went up to let's say the stock went to 140, what's the worst case on my cost basis? The worst case on the cost basis is wherever I buy the stock plus the risk of the trade. buy the stock at 140. My cost basis is 146.50. That's the worst case. That's the worst case. And right now, if I bought the stock at 140, my cost basis would be 146.50 roughly. I can sell an at the money call for $9.10. If I did that, I would be back in a high probability trade. So I'm going to roll up. What I'm going to do is roll the short call out. Worst case, I'm in a trade that makes, on that case, $360. So remember, the original trade made $350. This trade makes a little bit more money after I adjust and roll the call. So one of the keys on doing these trades is understanding the width between the short call and the long call. We don't want that to be too wide because we have to be thinking about what's the worst that can happen. And this is what I'm imploring you do is define your primary exit. Where does stock need to go? Where does volatility and time need to go in order for me to make money? When am I going to close the trade? Primary exit. Secondary exit is, what do I do if the trade goes wrong? Now, as you may realize, there's usually only one thing that can go right with your trade. There are multiple things that can go wrong with your trade. So I can't imagine the stock could go to 120, maybe 123.50, or maybe even all the way up to 130 or somewhere around, or even higher. So I've got a different adjustment strategy for how I'm going to adjust that trade depending on what it does. But every time, this is the important part to keep in mind, every time I do this, I'm adjusting into a high probability trade. I am Bayesian adjusting, keeping the odds on my side. This is truly, a lot of people say, oh, I want to be like an insurance company and you sell options. Listen, insurance companies don't just sell options, folks. First of all, they take your capital and go invest it. But the other thing they do is they buy insurance. They hedge themselves by buying long insurance as well. Now, they don't sell, they don't sell Melanie a homeowner's insurance and then go buy homeowner's insurance against Melanie, but they'll sell Eric and Michael and Greg and Melanie a homeowner's insurance and then buy one policy against all of those. So there's a business out there called reinsurance, and they aggregate entire portfolios. And that parallel in our world would be like doing a bunch of trades, but then hedging it with the SPX or hedging it with the NASDAQ that you could go buy. And that's an interesting discussion, but not really at hand today, maybe for the future. But the beautiful thing about this trade is if you've kept that risk relatively moderate, in this case, the rule of thumb that I use, you do not want your risk to be more than 3 times whatever the profit is. So 350, 650 is under 2. So that's right in my sweet spot where I want to do this trade. When that risk gets to be too big, then the ability for you to make adjustments when the thing goes too high are a little bit more of a challenge.
That's the perfect spot to sort of leave off because we are out of time.
Oh my gosh, did I just talk for 45 minutes?
Boom.
You did a beautiful job of for anybody who is looking really forward to hearing about the color trade. There's a couple of webinars back. You can go and look on the Lead Leg Live Media or Lead Leg Media YouTube channel. You can find a sort of a starter to the color trade, but I think Greg and Eric, you guys are going to come back on and do more of an in-depth look into the color trade in the future.
You need to register for a free webinar so we can talk more about this. And you folks can do it with thousands and tens of thousands of people have signed up for our program. We're the biggest education company in the world, even off the world. We've had astronauts use it on the space shuttle. So not on the space shuttle, but the International Space Station.
Just really quickly tell everybody where to go, where to find you, and then I'm sure everyone will be heading over there.
Special offer if you go to optionsanimal.com/LLM. Lead Lag Media. optionsanimal.com/LLM. Check it out. Check out a free webinar. Tell them hey, I was in Eric and Greg's webinar, and man, that guy talks a lot, but I want to learn more from him. So reach out, and I'd love to see you in another class. We'll talk more about this. This is fun. You can all do this, and I'm sure you want to check it out.
Well, Eric and Greg, thank you so much for joining me, and thanks to everyone who came here to watch. We'll see you all next time.